Interest rates have been holding steady in both Canada and the United States, giving consumers and businesses some stability after years of major swings. But with economic pressures continuing on both sides of the border, there are still plenty of questions about what comes next. I'm now joined by Brendan Caldwell, director of Caldwell Securities Limited, to break down what the current rate environment means for the economy and where monetary policy could be headed next. Brendan, thank you for the time.
Well, it should be an interesting one. There's a lot of noise and fuss, or as Shakespeare would have put it, much ado about nothing when it comes to interest rates. But we can make a conversation of it, I think, because it does. Interest rates really are the determining factor that governs most everything else. That, of course, and the president's comments on Truth Social. But let her rip.
Well, the Federal Reserve and the Bank of Canada have each kept their own rate unchanged for several meetings now. What has that steady stretch done for the economy on either side of the border?
Well, I don't know that either central bank has a choice but to keep rates steady for different reasons. In the U.S., the new president of the U.S. Federal Reserve, Mr. Warsh, uh, is traditionally quite what they would call a hawk when it comes to interest rates. He's been much in favor of raising interest rates to keep inflation down, but he is also a favorite of the president, so he was appointed with the view to his cutting rates. So they got the foot on the brake and the gas at the same time down there. But from a practical perspective, so much in the US is governed by politics that it seems unlikely to me that they really can't cut rates in the US. The economy there is already quite strong and inflation's quite, was on the verge of being quite robust. And we don't want another spike like we had a few years back in the wake of all the COVID money sloshing around. So they probably won't cut rates in the US anytime soon, but they're also not going to be able to raise rates between now and the US election. Again, so much is driven by politics there. So if there's going to be a change in the US rates, it's going to be after the midterm elections, which I think are the second Tuesday in November. Here in Canada, it's a different matter. And for different reasons, I don't think you're going to see much change in rates because until the Americans cut rates, it's going to be difficult for Canada to do so because it would probably end up weakening an already fairly weak loonie. The loonie was flirting with going under 70 cents US. Uh, and it was rallied in the last little bit because energy prices have rallied. And as you and I have discussed, we're the only normal petro currency on the face of the earth, besides perhaps Norway, because after that comes Mexico, Nigeria, and then the rabbit hole goes pretty deep after that. So higher energy prices have helped the Canadian dollar. But if we were to cut rates, it would very much undermine our dollar to a point where it would it would more look like the peso than the loonie. So I think that's interesting. What's happening as well, though, is because the U.S. is not raising rates, there is a fear of inflation in the U.S. and longer U.S. rates have been edging up. Now, why does this matter? Because the housing market in the US is largely based off the 30-year rate. Because most mortgages in the US are 30-year mortgages, or many certainly, which is very different than Canada, where if you were taking a mortgage out today, I would tell people, in fact, I have told my clients to uh, probably take a floating rate mortgage because I think our rates are going to come down, if anything. So that's where we're at. Long winded answer.
Now, I want to go back to one of your earlier points. With Donald Trump's new Fed chair, Kevin Warsh, now in the job, as you mentioned, who really holds the power over interest rates in the United States?
Well, it is we're talking the short term, the Fed funds rate, which is the rate they lend to the central banks, the Bank of Canada rate would be our equivalent. It really is the federal committee, the U.S. Federal Committee, Open Market Committee, that makes the decision. The last decision that they made on rates was a unanimous 12-0 decision to do nothing. Um, and they will probably make a few other 12-0 decisions between now and the midterm elections. That'd be my best guess. There is not consensus, though, despite uh, there seem to be uniformity of vote. There are others that think that there are some that think that rates should go up, others that think that rates should go down. So it'll be interesting to see. I do not think that Mr. Trump has too much power either over the Fed funds rate or who gets convicted for damaging his precious reflecting pool. So there's a lot which the president has tried to assert authority over, but his really only job is to appoint Fed governors and the Fed chair. But once appointed, they are really supposed to be independent. And he's tried his level best to get rid of one of them he disagreed with, but that came to nothing. So at least so far has come to nothing. So in terms of short-term rates, it really is the Federal Open Market Committee that makes the decision. Kevin Warsh sets the tone. I expect that tone will be neutral, probably to raise rising rates, but that wouldn't come toward the till the end of the year, early into 2027.
And how closely does the Bank of Canada tend to follow the Fed, and how much room does it have to set its own course?
We are the masters of our fate if we so choose to be. The issue is we have mortgaged our mastery by issuing just incredible amounts of debt, both through COVID, but now continuing on an ongoing basis. To the extent we owe lots and lots and lots of money, it might not be the worst thing in the world to see the Canadian dollar continue to weaken. But not very long ago, we were at parity with the US dollar. Now we're at 70 and a little bit cents. We have been in the past as low as 65 or less cents. And I do think there's some point where I think the number is 70 cents. When we get below that, we cease to really be a dollar and we become some other currency. For example, Australia has a dollar. Their dollar was a fraction of the Canadian dollar not all that long ago, and now it's at parity or even above the price of the loonie. So not just the United States, but other nations are strengthening around us, and that is not helpful for the wealth of Canadians. So we have some ability, but until we start actually getting serious about fiscal policy, which is Mark Carney and the Liberals' territory, is how much we borrow, how much we spend, how much we tax. Until we get serious about that, there's only so much that the Bank of Canada can do without having secondary effects. So if the US cuts rates, we probably have space to cut rates, but we do not have as much flexibility as we probably should have right now.
And Brendan, looking ahead, do you see rates changing anytime soon?
Depends what you mean by soon. I do think that long-term rates, 10 years and more, will probably continue to be on the higher side as long as people are afraid of inflation. And there's been a lot that has been inflationary over the last year or so. There's been the tariffs. We have no idea how those are going to get resolved. There have been, well, of course, the Strait of Hormuz crisis. I won't call it a war. And who knows how that gets itself resolved. But then there's just the overabundance of money just flooding the system. I do not actually believe inflation rates are as low as they're posted. So I understand why rates in the longer end have been heading up. But in terms of short term rates, I don't think either the Bank of Canada nor the US Federal Reserve will do too much between now and the US federal election, midterm elections in early November.
Well, Brendan, thank you so much for the time. We appreciate it.
Theresa, thank you.